Hello everybody and welcome back to another wild week on Wall Street. My name is Tagatha and I'm going to be taking you through some of the highs and lows of what's been going on in the market so far. We're going to kick things off with a lovely, gorgeous, beautiful heat map we have here in front of us. Everything's looking nice and green, except for energy minerals, which have been down in the dumps the last couple of weeks as everybody thinks that a recession is on the way. If we slide this down to a weekly heat map, things are actually looking equally as good. And let me tell you, it's been a while since I've said that. Second quarter earnings season has kicked off in the last couple of weeks. We started with big banks and now we're slowly edging into tech, which is all very exciting. And that is actually some of what we're going to chat about today. We are going to kick things off with Netflix, exciting stuff. I'm sure you all remember back in April when Netflix did that. Dropped 35% in one day, its biggest single day drop since 2004. And wiped like $54 billion off its market cap or something crazy like that, all in one day. Why did that happen? Well, its last earnings report said that for the first time in 10 years, subscribers were leaving the platform at a faster rate than they were joining. So they reported a loss of about 200,000 subscribers. So everybody, as you can see, the prices have not recovered in the last couple of months, and everybody has been very anxiously waiting to see what this quarter had in store. Now we know, they reported yesterday after the bell, and good news, they only lost 1 million subscribers. I know what you're thinking, that's not good news, but it actually is if you compare it to the 2 million that it forecast it would lose in its first quarter report in April. They say that they have been investigating why all these people are flocking away from the platform, and they put it down to three main things. The economy, which to be fair, everybody's struggling with at the moment, growing competition, and password sharing. But don't you worry, because they've got a plan. First up, they are going to be, or they have already agreed to team up with Microsoft to serve a cheaper ad-supported tier onto the service. So basically, you pay less money, but you have to watch ads in between your series. They have been resisting that ever since their inception. They say it's not their vibe, they don't want to do it, but they've now kind of been cornered by a lot of other rivals putting ads on their platform, and also obviously these sinking subscriber numbers. So we've got an ad tier coming our way. Second up, they're going to be massively cracking down on password sharing. So everybody get your house in order. They think that too many people are sharing passwords, which to be fair, they probably are. Like half of my subscriptions actually belong to somebody else. So they're going to say that if you would like to add an extra household onto your subscription, you'll need to pay an extra little fee. People aren't entirely sure how that's going to work out with devices, etc., but we've got that to look forward to. We have also got a huge new slate of content to look forward to. They say that they've got a bunch of stuff in the wings that they're hoping, as Stranger Things did this season, will bring in a whole bunch of new subscribers to the platform. But only time will tell. Obviously, if you compare it to the 20 million new subscribers that analysts thought they were going to see this year, the numbers are quite shocking. But in comparison to last quarter's forecast, we're actually looking pretty good, which is probably why the stock had a little jump in after hours trading or open of trading today. Tech earnings are soon going to be in full swing. IBM actually kicked us off earlier this week, and their earnings were actually not too bad. The stock slid because of their outlook, but actually, all in all, they weren't doing too badly. However, what they did do is flash a big old red warning signal for the rest of the tech industry on something that is probably going to affect all of them, and that is the strength of the dollar. It's been trending for ages now, but the dollar has been reaching fresh new highs almost every day. This month, they reached a fresh new 20-year high on the 14th of July. Obviously, this week things have taken a little bit of a tumble, but up until then, the strength of the dollar was really going for it. That is impacting the profits of companies that generate a lot of revenue from overseas, because like Netflix, pretty much any other big tech company to be fair, because those companies then have to translate or convert sales in local currency back to dollars, and it's kind of messing them up a little bit. It's likely that others will have a similar problem. Even the biggest of big tech is struggling at the moment. We got news this week that Apple will be slowing their hiring and spending growth for some of their teams next year. Now, this is not going to impact all of their teams. It will probably mostly play a role in like the halting of actual hiring and maybe not backfilling any of the roles that they need to. But they promise all of us that they've still got a full and thriving product launch list ready and waiting for the next couple of quarters, including their new headset, which is actually their first major new category since 2015. So that's quite exciting. A lot of their peers have been doing similar things. Netflix is slowing down hiring. Alphabet, Amazon says they're overstaffed. Not entirely shocking when you think about all the hiring they've been doing recently. Uber, Tesla, all of them slowing their roll to try and stockpile their cash in the event of a recession. Apple, obviously this is a notable thing for Apple to have done specifically because traditionally they do tend to beat analyst expectations and they do tend to weather economic downturns better than other people. So the fact that they're sort of bracing for impact is potentially worrying for the rest of the industry. Apple lost 2.1% when that news hit on Monday. And it was their biggest one-day drop in about 3 weeks. They're down about 20% for the year. And if we take a look at the rest of the FANG gang, they're doing equally as badly. As you can see, they've been slowly but steadily declining, although there has been a nice little dip here. Apple will be giving us their earnings at the end of the month. Everybody's a little bit nervous because a report came out this week saying that global smartphone sales have dropped by 9% this quarter. Obviously, smartphones are like a lot of the things that Apple do. So people are a bit nervous, but only time will tell. Make sure you're keeping a close eye on that and the rest of the tech industry. Now, speaking of industry-wide news, we got an exciting little update yesterday from the semiconductor industry. So the Senate has passed through a piece of legislation called the CHIPS Act. Now, what the CHIPS Act essentially aims to do is boost semiconductor manufacturing in the US to boost their competition against China. So China has been accelerating their semiconductor production for the last couple of years, and now they account for 10% of all global sales. Especially in light of the shortage that everybody in the industry is facing, the US wants to up its game, and they want to invest $52 billion through this CHIPS Act into boosting manufacturing. It's going to be filled with a bunch of tax breaks, subsidies, etc., and the Senate, with bipartisan support, passed this act on Tuesday. However, it did cause a little bit of infighting within the chip industry. There was a semi-small group of chip companies that were considering protesting the act, not because of the act itself, but because of the final language of the act. They reckon that it will mean that a lot of that $52 billion will be dedicated to chip manufacturers like Intel, as opposed to chip designers like AMD or Intel. However, they didn't make a move. The act passed on Tuesday, and they all kind of rallied in return. The iShares Semiconductor ETF was up 4.4% on Tuesday and is up now another 2.2% in Wednesday morning trading. AMD, Nvidia, Intel, Qualcomm, all of them saw gains yesterday. Obviously, they're thinking we really need the cash no matter what. There's been a lot of forecasts coming out about what analysts think that the chip industry is going to do. Wedbush, for example, reckons it's nowhere near over and that the slowdown is going to bite. However, Volvo, for instance, thinks that it could be coming to a close soon. Either way, the semiconductor industry obviously needs some TLC, and the US government is here to give it to them. Again, make sure you're watching this closely. There's bound to be some moves made on this front. And don't forget that we cover all of that and more on our Snaps page. We also send a daily email that's in your inbox by 9 a.m. So make sure you're keeping up. And until we chat next, always remember to look first and then leap.